This is why it's so important for a lot of you investors to be precise with what you want exposure in stage 2 of AI.
Welcome to Investing with the Boys, episode 3, season 2. Earnings season is finally coming to a break. Thank goodness. This has been a crazy couple of weeks, but we're still seeing a lot of volatility in the portfolio and in the market as well. We got your boy Logical here. We got Shy and Sam, myself, ready to kick it off. I mean, let's just get right into it, guys. Software has been decimated since our last episode last week, just completely obliterated. CRM is pretty much trading near its 52-week lows, GitLab near its 52-week lows, BRZE, AMPL, and so on. All these companies is getting decked right now. But today we are recording on Wednesday, August 13, where we've seen quite a bounce. Did we bottom? Did we bottom software? It might have bottomed. The market certainly didn't bottom. The market had closed again at all-time highs. And here we are, guys. Also, that might be a little bit of a Cisco at the end of that one. They just reported earnings today, so we got to take a look at those numbers. But yeah, let's kick it off with some software. Logical, I know you were in some software names. How's that going out? How's that going out for you?
Yeah, so I've finally just decided that it's time to stop getting too cute with it. You know, I was looking at a lot of these software names approaching their lows, and I'm just thinking, look, this is not the end of these companies. I've worked in corporate environments for the last 10 years. I know that these software companies aren't going anywhere. They're completely intertwined with a lot of these businesses. Sure, there could be new entrants because of lower barriers to entry from the development side of these softwares. But let's be real. Are you really going to sacrifice, whether some new company can give you a 50% price discount on this software, but it really makes up just 1% of your total budget? Like, are you really going to compromise something that might be very core and critical to your business? I don't think so. So I think that if I ran a multi-billion-dollar organization, I wouldn't really be trying to disrupt my business and affecting potential revenues with some sort of small price cuts here and there. I look at companies like, we talked about GitLab on here. I mean, it's approaching its lows. It's trading at a very reasonable multiple. They have really high free cash flow margins, up there with Snowflake. Obviously, Snowflake is more of a platform play. But you're looking at really good revenue growth last quarter at 27% revenue growth. I think they're like 35% free cash flow margins, which is absurd. And I just saw, actually, funny enough, today, a big lot of calls come in for GitLab. They got earnings on September 2nd. So that one's looking pretty good from the lows here. If you remember DigitalOcean, we talked about last time, that had a really good earnings. That one didn't make any new lows. GitLab has yet to make new lows, and it was DigitalOcean was basically saved by the catalyst of its earnings, and it popped from there. We got a little bit of a offering to kind of refinance some of those 2026 notes they had, kick that count down the road. Very expected, yet the market kind of punished it. Another opportunity to add to that name. And then, if we look around, again, I'm talking about that idea of specific software names. Did it make sense for them to fall to where they are? OKTA, for example, like identity access management. I mean, this is critical to a business and how it functions. To let up on your cybersecurity front, are you going to be that CFO or that CTO who tries to find some sort of workaround? No, I don't think so. And actually, OKTA, they've been buying calls for some weeks now. So this thing is approaching the bottom of its range lows as well. I mean, all of software has been dead. And then you got to decide which one's the AI loser and which one's the AI winner. A couple names before I pass this off to Shy, just wanted to touch on, BRZE. BRZE is a company that's trading at, something like 3 times EV to sales right now, growing 20% on the top line. Yes, they're just now inflecting to profitability, so not huge, free cash flow margins there, but they could get there. And they're implementing this, reinforced learning through some acquisitions they made of OfferFit, where they are trying to implement not just, marketing to your users and increasing your retention, but also having A/B testing going out and have reinforced learning to improve those tests as you go. So I think they fit really well, and they're leveraging AI. And I just don't see how, a business using them is going to just somehow, find someone else who's doing this at their level, their capacity, their scale. So, I think about, BRZE is a company that it's not just about marketing and growing through awareness. You're actually trying to retain your current client base. And that's something that I don't think companies are willing to sacrifice. So I think the narrative is wrong. It's back down to its October 2022 lows. I mean, we're talking about a business that has gotten better 3 years in a row, and it's now trading back to those prices. that screams opportunity to me. And I've worked with these products. I understand how they work. Sorry, last one before I go on to Shai, just because I'm on fire mode here. We're doing the lightning round, Jim Cramer, is Amplitude. I was listening to that earnings call. I can't believe this thing. It was up 16%. They re-accelerated ARR growth. They're talking about their AI agent product and how it's so successful and customers are so interested. That stock was up 16% on earnings, faded that entire move. And it was back down to pre-earnings levels, almost lost a 200-day. It did actually for a quick second, but it doesn't make sense. These things are trading at like 4 times EV to ARR. I mean, it's accelerating the growth. They're implementing new products. The management team seems energized. And so I think they're going to also be an AI winner. You would think, oh, but it's a product analytics dashboard. How does that make sense? Wouldn't they be the first to be phased out? The truth is, they're going to be the ones implementing the AI agents to make it easier for the end user. So you're seeing the numbers in the stability of their net retention. You're seeing the growth in their ARR. And I just think that a lot of these companies are being written off. I'm going to chalk it up to a weak and volatile earnings cycle where every company that's been reporting, even 1% miss, even the companies that are beating are just seeing fades in price action. And I love when the fundamentals in the business story gets better and the price gets cheaper. So that's what I've been focusing on. A lot of good names here. I've been going overweight software. Shai, sorry, that was a mouthful. Please take it away.
No, I mean, I think what's happening in software, I kind of think it's a different take. I want to say it makes sense what's happening in software, and I think there's going to be more pain, actually. And the reason for that is that AI tsunami you hear me talking about, it's coming for the whole sector. And right now, that whole sector is getting re-rated. It could be positive, it could be negative. Most likely it's going to be negative, but they're preparing themselves for that tsunami because there's a world where software becomes, or middleware specifically, becomes a commodity. It becomes a repricing of like what multiple do you price these software companies where these AI native customers can create these competing products, makes their product a commodity. What is the price multiple for that? Is it 25 times free cash flow, 20 times free cash flow? So right now they're going through a whole sector re-rating for BRZE. For BRZE specifically, let's just say, is that more of a CRM? Would you call that? Like what bucket would you say BRZE is?
I don't know if I would say CRM. It's more of like a marketing software because it helps you send push notifications. It manages all of your connections. So it's CRM.
It's close to HubSpot, right? It's like a HubSpot-like-ish type of thing. Yeah. So that sector, mid-tier CRMs are getting re-rated hard. You just saw what happened to Monday.com this week. So I'm looking at BRZE right now. It's trading at 40 to 45 times free cash flow multiple. The Rule 40 score adjusted is at 25. Right now for Monday, we have a Rule 40 score of 52, 2x, and it's trading at 25 times their free cash flow.
I got to push back. I'm so sorry.
No, don't apologize.
Using free cash flow multiples on a stock that is barely inflecting to free cash flow profitability.
Okay, I didn't know that. Okay, so
I would
you say
sales multiple there probably right now.
All right, so let's see their sales multiple right now.
It's like 3 times, 4 times, if that.
4 times. Okay, so what's Monday.com's?
And again, by the way, I'm not even against Monday.com. I like Monday.com for a trade. I think it was an overreaction, and we've talked about this. I like it for a trade. I'm long for a trade.
Huge overreaction.
Agreed. But okay, let me continue. The reason I was saying that though, BRZE, there's this AI tsunami coming. BRZE doesn't have the luxury of the margins right now to get ahead of it, to pivot, to do all the necessary moves. Salesforce, HubSpot, Monday, they all have very juicy bottom line margins, like 25% plus, while growing their top line significantly as well. Where at Salesforce, I'm excluding that. They're going to win the large enterprises. Nobody's going to tackle Salesforce or large enterprises. I think everyone else will be tackling the mid-market space. And I think that right now, what's happening in CRMs is going to continue happening going forward because we're not going to get a resolution on are they past the AI tsunami for a while. It's going to be a weird opportunity cost issue.
Can I say one more thing? Just I like Monday for a trade. I think it was an overreaction. I think it is too cheap of a stock. But if I'm being totally honest, I'm way more bearish medium to long term on Monday than I am on BRZE.
Well, what does BRZE offer that Monday doesn't? Let's get into that then.
BRZE allows you, it's a very critical point, to speak to your customers with a very personalized way. It's very important. It's critical to revenue and retention. I don't see how Monday, which is kind of like a project management software, is ever going to have anything that's, persists.
Well, this is the problem with Monday.com. They have a large concentration of their revenue come from small business, right? So I don't know what BRZE is. I haven't done too much research on that one, but this is the reason why Salesforce isn't selling at some ridiculous multiple. Still is, I would not buy Salesforce, mostly because I think I can make more money somewhere else. But on top of that, Monday.com, when you're talking about small business, the stickiness of a product for a small business that may not even be in business in a few years is a lot less sticky than Salesforce itself. BRZE, does BRZE have a lot of enterprise clients?
I would say more so because given that they're trying to like be able to connect with like customers, if they have an app, for example, you could send in-app messages, you could do all sorts of like, there's a lot more of the marketing campaign stuff to your existing client base. Yeah. So, and then by the way, I don't actually like Salesforce at all. I think most of their software is actually commoditized. I mean, dashboarding and like, you know, anyone can make up dashboard software, data visualization software.
Yeah, but it's the data that Salesforce owns they'll be able to leverage. That's the
that
thing.
could be it. Yep.
Yeah.
That totally makes sense to me. But besides that, to me, it's a commodity business. And I don't disagree with you guys that like AI is gonna shine the light on who is a commodity and who isn't.
I'm not that aggressive with this argument. Okay. I think maybe over the next 4 or 5 years, I think a lot of these companies that exist today, especially in the smaller business sector, including Sentinel One, in my opinion, I don't think they're going to be around in a few years. Maybe more in the latter end, maybe around 4 or 5 years, only because this doesn't happen overnight. The narrative, of course, is building up because, of course, these stocks have pulled back materially from their highs. And then, of course, they posted bad numbers in a quarter where spending was very restricted last quarter. And the guidance certainly doesn't help for a lot of these companies. But at the same time, like, dude, Monday.com is going to be around in a couple of years. It'll for sure be around. They even though that it's not as sticky as Salesforce product in general, they still are retaining their customers and making them pay more. So in order to get rid of those customers, you do have to put in a lot of effort and dollars into building software that isn't integrated with Monday as much as it is right now.
So I do think Monday though is going to be around, but they're going to get rated much lower going forward because I do think they're they're not going to be able to maintain a Rule 40 score of 50 plus. I think what you're seeing with Microsoft and Google
adjusted
alone, yeah, it's or even adjusted. It's what like the bigger players, the Microsoft and Googles, are doing already on their AI-driven CRM capabilities of just putting them directly into their productivity stacks at no extra cost to the users. There's no world that Monday can compete with that. So yes, that's why their like whole bread and butter is SMBs right now, because they can't really go for the larger enterprises when their Googles and the Microsofts are essentially adding CRMs at no additional cost. Like there's no competition in that. Everyone like Google owns your workday. Like that was the whole thing about Google for me, where yes, AI finally can provide competition for search for the first time maybe in its existence, but Google still earns your day, like Google Maps, Google Calendar, Google Gmail, Google Drive, like all those things you will not leave. And they're infusing Gemini as that connectivity layer across all those workspace products. There's going to be an easy add-on for CRMs as well. So I think that's also excluding that ServiceNow is making a major pivot towards CRM space. Like I don't want to call it a CRM, but it just shows how easy it is for these large enterprise SaaS companies to add a CRM spice now associated with them. So I think that you have to be a Monday.com shareholder. Like I am participating in the trade right now purely because here, let me share my screen.
I'd rather buy ServiceNow here at what are they, like 11 times EV NTM right now versus Monday.com where they at right now, even if it's for a trade. Because I think if we're thinking about a recovery play, I think ServiceNow is going to make a much stronger recovery than Monday.com, even though it's at a more expensive multiple. But that's handed because of its profitability metric. Also on top of its retention and the fact that almost every single enterprise company in the entire world is a client of ServiceNow. Plus, I mean, you can't really turn your back on Billy M. I mean, Bill McDermott is just a dog. You probably know. I don't know. You guys talk to Bill.
No, first off, he is probably the swaggiest CEO I've ever met in person.
For sure.
Is like one
Subtle
of my favorite
right there. Subtle flex.
No, but one of my favorite dude, he was like leather. He's really like that in real life. But anyway, so this CRM comp tool, this is exactly why I participate in the Monday.com trade. Like I have way too much cash right now. I have a 15% cash position. I need to have that work for me until my higher conviction plays come back to my buy range. Monday got brutalized on Monday. Was it down like 30% at one point? I
27,
don't know.
yeah.
It was.
So
No pun
I think
intended.
that, no pun intended. I was laughing as well. Same with you. So anyway, so this is the CRM comp tool. I was like, all right, is Monday a good investment? So I added these 5 names over here. This Aerometer score, this factors in EV to gross profit, free cash flow margins, revenue growth, all into one score. The lower the score, that means the more undervalued, or maybe market doesn't think they have a moat. The higher the score, much higher moats. And their market's giving them a premium. They could be overvalued. That will get re-rated on disappointing earnings.
Shai, is this
Yeah.
is it broken? Because it to me it says that Asana has the biggest moat in this sheet.
No. I think this shows to you how overvalued Asana is.
Asana is going to be non-existent.
No. It's funny you say that because
they're going to be gone.
I think I need to add another layer to this because Dano had the same comments you did. Logical. So I think for this is more of a valuation. Exclude the moats. It's a valuation. So right now, this whole bucket's trading at 20 times. Does Monday.com deserve to have a 15% discount to the second lowest score in this bucket? Absolutely not. Like, I think it needs to be at least at what the comp is. I think Salesforce should be above the comp. I think HubSpot should be second. Monday.com should not be the lowest. I think it needs to get re-rated to closer to 20. And what is that? Justify. It's like a 30% move. So I think this is a potential trade for 230, 240. I think Asana has a ton of risk on downside in this upcoming earnings cycle, like a Confluent like move if they just completely disappoint. I also think that their CEO just keeps buying their stock. So I think it's like a high floor from that. And Salesforce is interesting where
he's been buying this stock the whole way.
He's just been buying the stock. Yeah.
He's been buying it for years, though. He has not been a good timer of his stock at all.
Let's do ServiceNow right now, real quick. All right. Let's just include ServiceNow into the CRM tool space. This makes sense to me. They would have a significant premium. But let's just go back to this. Let's go to the software one for data consumption. All right. So using that same metric right here, what surprises you here, guys? On the valuation front.
What do you? I feel like this is a trick question.
Well, GitLab is obviously really cheap.
Very
cheap.
Mongo is probably way too expensive.
I think Mongo might have a Confluent like Mongo might have a Confluent like move this earnings cycle. I think this is showing me that there is a premium. It's not as cheap as people anticipate. They are growing the second lows here among the group, but look at their free cash flow multiple. I know they have a different business model. They have open source. They sacrifice, but they sacrifice upfront costs on free cash flow to get people in their ecosystem because it's sticky. But I think part of the AI tsunami narrative that we're talking about is open source was such a tailwind for all these companies, but now it's their consumption. It's not their consumption. It's their monetization headwind now because these AI native customers are using their open source product and saying, okay, thanks for giving us this. We're going to take it from here and create a competing product with their managed services. So I think here, the average is 26 times. I think it makes sense that Snowflake is the top dog in this space. I think that Datadog deserves to have a 25% discount to Snowflake because observability might be a risk in the AI tsunami, and they have incredible margins. Rule 40 scores significant, so they deserve a second spot here. But Mongo, that's what shocked me, and I think I could see a big discount.
It was a hot trader stock, and I don't think it's a trader stock anymore. And that's the problem with MongoDB is that you don't have these gamma squeezes that they usually had before. Also, I don't think it's so much a short squeeze. I think it'd be more of a gamma squeeze that he used to have back then, maybe like 2023 when it was $500, which is egregious. But at the same time, and I'm sure you know this, a lot of the enterprises, the large Fortune 500 companies, when it comes to monitoring, there's two applications that are open source that a lot of companies are using very heavily as they're customizing it to their own liking. There's Grafana, which they're using for visuals, and there's also Prometheus, which is collecting the metrics from a lot of these servers. Both open source. You can easily host it on your own server. What do you think Meta is going to be doing? you think Meta's going to go out there and buy Datadog, or are they going to build something themselves? Meta is notorious for cutting costs left and right. I don't know for sure because I don't work in Meta, but I think they're going to go the route, if they haven't already done, to take an open source product and customize it their own liking and then save hundreds of $millions a year because of their gigantic infrastructure they have in their environment.
CrowdStrike's already doing that. Like all these cyber companies are already creating their observability tool themselves. And that's way stickier than a third-party vendor like Datadog.
You know, I mean, it was bad timing for me because I think it was like about 6 months ago. I was pretty bearish Datadog when it was around 110. Terrible timing because I bought them like in the high 90s in April, right? I think actually it was the high 80s, and then they bounced back considerably, but now they're pulling back again. Even though they had a great quarter, this is another one of those companies that they had a really good quarter, but then they just got sold off after their earnings. And I think that this was my argument back then. It was just bad timing for it, but my argument still stands that when you have CrowdStrike basically growing their CM segment at triple digits, that at some point will eat into the observability sector, right? Even though it's not the same thing, CrowdStrike's doing it from a vulnerability perspective. They're not doing it from just a monitoring perspective as far as alerts and application usage and so on. But at some point, people are going to start looking at that as like, hey, what if we can just get the data that CrowdStrike is offering and then just build our alerts on our own using some sort of product that the hyperscalers offer, whether that's AWS, Azure, or Google Cloud Platform. Since your data and since all of your infrastructure is sitting on those platforms, why not use the out-of-the-box product that they offer at a much cheaper price and then just build your own product that's able to alert you using open source tools? I think that this is probably the issue because I've seen it happen in more than a few companies because Datadog is definitely not a cheap product, but also the dependency gets pretty high because then you don't have to worry about people in-house managing all that infrastructure. But if you're thinking about cutting costs, cutting engineers, maybe that might be something that's a low-hanging fruit for CIO to get rid of.
So I'm going to tie a knot on this software conversation because we got to go into hardware. This is why it's so important for a lot of you investors to be precise with what you want exposure in stage 2 of AI, where you want to place your capital. This history doesn't repeat itself, but it often rhymes. You were bullish on the .com era. You didn't put your money in the darlings of that era that were building the online marketplaces on top of the internet, the Googles, Amazons, etc. Like right now, you can be absolutely bullish on stage 2 AI if the application's built on top of all this hardware, but you chose the wrong horse in the race. Don't be like that. You have to dig deeper. Like we're past the point now, I think, in the software space of throwing money at anything with some kind of language model demo or this CEO calling it a platform on the earnings call. Like the market's moved on. And I think you're seeing that recently that they want proof now. No more just BS substance or corporate jargon on the conference calls. Now it's all about operational leverage. What's their go-to-market strength, customer stickiness, and most critically, who controls their infrastructure and monetizes it at scale? That's the difference between stage 1, hardware, servers, compute, to stage 2, AI investing, where stage 1 was a lot of narrative. Stage 2 is going to be a lot about infrastructure control, that ecosystem defensibility, and then the monetization pathways that doesn't collapse when your smartest customers, aka AI native customers, the open AIs of the world, stop needing your cloud and create their own alternative solution. So it's not enough to have a great product. You need distribution leverage. You need some kind of value that's really hard to displace, aka Cloudflare, aka Palantir, aka Axon Cloud, and a roadmap that survives, or a lifeboat that survives from that AI tsunami, where LLMs and inference are going to increasingly become commoditized, that a lot of these applications are going to be very similar to what servers were in the cloud era, that they're going to be priced accordingly. So be very quick to pivot. This earnings season, I've dumped a couple of my holdings that I've held for years. Like I'm not willing to buy and hold is kind of dead right now with how quickly things are moving. And you need to pivot towards proven winners. And
you know that.
be aggressive with it. And that's why we're going to go towards hardware. And I want to toss up one tick. Oh, what do you want to say?
Just real quick, since we're already talking about data, because out of all of us, I feel like when we're talking about data in terms of people who have hands-on experience, Logical has the most experience because I don't know.
Hey, I monitor my scientists.
You might be you might be a scientist in the field. We'll see. But has there ever been a case in your company or even yourself where you've had, a sticky product like, let's say, Snowflake or something, and then your company has built something in-house or figured out a way to kind of push the dependency on that application out the door?
Look, I would just say that generally you're not going to build in-house software. Not happening. It's it's out of your wheelhouse. It doesn't make sense to throw maybe $1 million of resources out of your budget to build a team, see what, throw it, see what sticks. Basically, it's just not.
Let me pause there, Logical. What's your company's cloud provider, cloud service? Like, which one do you guys use? Azure, AWS?
Databricks. AWS, I think. Yeah,
AWS. So the theory is AWS will create these software products, not the actual business that you work for.
Well, yeah, that's the kind of theory. That's always the thing.
But hold on, real quick. They've been doing that with things like for Snowflake competitors, and that's not catching on, right?
Well, that was before AI, though. They didn't have they had the resources. They didn't want to invest in having to do that. Now they have an AI agent that can work 24/7, one-time costs, that now provides those alternative products. That's the different.
That's also
different
because we're in a time now where this isn't 2021 anymore, and that you can't just basically borrow debt for essentially free interest. Obviously, we've been in this case for 3 years, but companies are getting squeezed, right? Like, especially the much smaller companies. Like we just saw with DigitalOcean, okay? They had to issue debt. Would they have done that in 2021? Well, maybe actually they would have done that, but I'm sure they didn't want to do it.
Time it. That thing is a huge misconception on DigitalOcean. Like, this was their previous CEO and CFO, got the worst kind of loan that was going to materialize in 2026. That was been known for 5 years. And that's why you've seen a bounce from that stupid pullback. It's up 6% today, up 2% yesterday.
But
yeah, I just want to add that.
My point is that CIOs are getting squeezed in terms of their budget. They have to cut costs. Like we've been in this high rate environment for too long, much longer than people anticipated. Almost every single CIO across the board, and including the market itself, thought, "Hey, Powell cut rates very fast. He hiked rates very fast. He's gonna cut rates very fast." And the reason why this is important is because when you have to borrow debt at any degree, or even if your clients have to borrow debt in any degree, if your client runs out of money, you're going to run out of money, because that means that your clients are going to stop spending as much. And I feel like this squeeze has been happening for over 3 years. So now you're starting to see the effect of it for companies that don't need certain products and are now finding like, hey, I don't need Datadog anymore. I'm just going to use AWS CloudWatch from now on. Even though we have to configure a little bit of tools and whatever, it'll save us $10 million a year. Let's go ahead and do it. I feel like that is where the real question actually comes from. That's why it's actually happening today versus happening 3 years ago.
Who's spending $10 million? Who's saving $10 million on a contract? Nobody's doing that. That's not how much contracts cost.
The open AIs of the world.
Yeah, they are.
Well, okay. I mean, sure, right? But most people aren't like spending that much money. What are they going to save to do that entire migration? I mean, let's just think about the economics here.
They do it.
No, here's the tell though. This budget cycle, it's in December, 3 months away. We're going to really see how much cutback there will be on software spend in 2026. Like, this is the moment where I feel like there's that inflection period in enterprises where we see what's BS, what's real.
Yes.
And I think we're gonna see, what is it, April of next year, the real like full year guidances. That AI tsunami, I think that's the first moment we're gonna see how bad the tsunami is and how close it is to everyone.
Well, that's why you always see software stocks pull back during the summer, because they get ready for the end of the year budget. That's when before the end of the fiscal year, because most companies have a fiscal year separate from the calendar year, they need to make room for these budgets, and they need to start allocating funds towards certain things that are actually prioritized, right? So if you're prioritizing AI, which I'm guessing is a very high priority for a lot of companies out there, which, yeah, AI is pretty important, right? They're going to put the money toward that versus putting it toward an open source product that's available that they're paying top dollar for to have a managed solution. They're going to do that. Whether or not it costs them money or not, they'll just figure it out later. Because at the end of the day, when you have costs for an application, that is a much easier thing to cut than the engineer's time that you're going to reallocate their hours for in building something custom for it.
Totally.
Yeah, let's just see what happens, right? We've talked enough about software.
Short everything.
All right. Let me set up for the next conversation, the hardware, but specifically A very popular FinTwin name. Let's talk TSSI. Logical, what's your thoughts on that?
Widowmaker.
Look, I mean, they're in the very much of a hardware space. There's really no like optionality in their business. You know, it's like the server rack infrastructure of the data center. There are two things that I want to point out with this business that make it absolutely uninvestable. When I look at the earnings reports, I kind of chuckle because look at these numbers. I just had it up. Where to go? Okay, right here. So revenues up 262%. Gross profit up 72%. They have negative operating leverage. The more money they make, the less money they make. It's just the opposite of what you want to see.
Isn't that's what's happening at CoreWeave though? I think that's like kind of the AI investment phase right now for everyone. No, is it different?
I mean, look, my point is that people love to talk about these things are growing so fast, but why does it matter if it's not economical to the business? Like the whole point is, okay, so what? You're just going to keep getting more volumes and then you're going to see pennies on the dollar. Like they're doing $44 million of revenue. Gross profit is sitting at 7.8 million. What is that? Like less than 20% gross margins. And gross margins is actually contracting every quarter if that revenue is growing faster than gross margins. So it's just net income is, you know, $1.5 million. I mean, they're sitting at like a 1%. If they're reaching this level of scale and they're still barely breaking even, I mean, again, I think the gross margins give you a better idea of how profitable this business can be potentially, especially at scale. And right now, it's just not reaching that level.
What's their gross margin right now?
I said it's just under 20%. It's like, I don't know.
That's pretty high for servers though, because Supermicro's a 9%. So that's actually kind of interesting. They have 2x Supermicro's margins.
Dell has pretty high gross margin for their business too, but also they have a concentration risk for their client.
I was going to say the second thing that makes it uninvestable is I was just pulling up the 10Q. Okay, I love this. The following customer accounted for a significant percentage of our revenues. Oh, really? Dell made up 98% of their revenues.
Just significant. Just significant. Significant.
If Dell turned them
Understatement.
off, destroyed. And also that makes it absolutely uninvestable. That makes it more uninvestable than like the other.
Just invest in Dell. Why would anyone else?
Exactly.
You know the funniest part about this in the 10Q is like the next line. This is standard boilerplate statement in the 10Q. No other customers represented more than 10% of our revenues. Oh, you think there's only 2% left?
Oh my God. That's crazy.
I've been talking about this Dell concentration for a long time. It just never made much sense to me. I don't know. Do you guys have any other thoughts about TSSI? I'd like to talk about an actual, I think, what could be a real winner in the data center hardware space. But you guys let me know any other thoughts on TSSI.
No, here I'll do a layup for you. But there was a recent company, not recent, but there was a company that was basically a SPAC in 2021 or 2020. I forget the exact same year. VRT, Vertiv Holdings, which I think is probably going to see a massive uptick even from here. And like you said, and like you've mentioned before, I want you to introduce it. But I think that this space is, I don't want to say mispriced because a lot of people are already sniffing it out. But I don't think people see how important this sector is when it comes to just basically bolting out inference queries at lightning speed and how important cooling is happening in a data center. I'm not too familiar with this business. So go ahead, bring up the company you want to bring up.
Yeah, so the company is a small cap. Just because we talked about TSSI, which is a popular FinTwit name, I think this is a name that deserves a lot more credit. Is TGEN, and you're gonna say, well, logical. I just looked up the chart and it's up like 8x in a year. Yes, it is. But this company just started to hit its true strides, and I'll give you the quick pitch. This is a company that has an LNG powered cooling chiller or whatever. Like they use these. I don't know what the word is for it. They have like a cooler for data centers that are not electric powered. Why is that important? Is because you want to use electricity specifically for all of your IT needs in the data with the data servers and whatnot. So LNG gives you another fuel source essentially. So why is this important? It's so different than what's been used by Vertiv, who is the leader in this space, who is, by the way, a $50 billion company, that they saw potential in this $100 million market cap company, TGEN, because they have these IP patents. The CEO owns a ton of their own stock. I mean, he's a real scientist, and they've developed this technology to be different and something that, you know, could be very useful for the data center space, in the sense that, you might be running at extremely hot temperatures, and you need to have these chillers basically. So Vertiv and them forged a partnership where Vertiv will be cross-selling their chillers into data center projects. So it's very interesting. I think, speculatively, this could potentially make for a bolt-on acquisition for a Vertiv group down the road. The financials today don't look that great because that uptick in data center revenue is not there yet. But what I can say is that a couple weeks ago, they had a pretty subtle offering filed. They didn't have a PR around it at all, but the use of proceeds were around advancing the data center expansion opportunity. I thought that was really bullish language. I re-entered the position after trading around it a bit. Just yesterday, they reported earnings, and I was hoping to see if they have some data center language. Now, look, the data center revenues are not quite there yet, but they just signed a letter of intent for their first 6 chillers on a 100 megawatt data center project. And if they do well in that, initial pilot project, then they can have the rest of the potential of that project of 500 megawatts. So that can increase it. They just started putting in a couple bids for other data center projects that could end up having hundreds of chillers. So that could end up, if they end up signing one of these, potential data center projects, the backlog in revenue can end up being multiples of today's market cap. So I think that's why it's a really interesting opportunity. It's still obviously very speculative because they need to make it through that, pilot project. But the tech seems legit, so much so that Vertiv has brought them on. So this is, TGEN. I think it could be a really interesting one. And the beautiful part about it is it's a 44% gross margin business, much better than a TSSI structurally. And then long term, they'll also have a service component of that revenue, which will be higher margin as well. So I think that volumes are going to tick up on the already high hardware gross margins. And so I think it just makes a very, very compelling long term, as long as they're able to prove it out with this pilot project and land more of these data center deals. But it's probably going to be into 2026 when we actually start seeing substantial revenues come in. Obviously, there's still a bit of a binary aspect to it of does this all go well? Do they get signups? But if they do, the upside can be tremendous. Something that you don't want to oversize, but yeah.
Can I ask you this? Why is Vertiv outgrowing TGEN?
TGEN has 0 data center revenues right now. They are just now starting they just got signed onto their platform maybe 1 to 2 quarters ago. They just landed a pilot project in that letter of intent noted yesterday. Data center revenues are not part of this business quite yet.
Did you read on or hear about the Amazon news on creating the Vertiv competitor? And that's
I did
Vertiv,
see something like that, but I didn't see much impact or ripple effect from that. I did see something about their own coolers, but those are still electric powered coolers. So TechoGen is LNG. So it's natural gas.
This is the conversation we're having, exactly what's going to be so difficult in the new post AI world, where why can't these bigger players who are obviously investing in this space create these competing offerings? If AWS is doing the Vertiv competitor, why not the TGEN competitor in a year or two?
It's a good question. One, I still think it's pretty under the radar because this is still a really small company. Who the heck knows even about this? Two, I would say that they have a ton of patents. It's a legitimate company with legitimate tech. So I don't know. I'd imagine those patents hold up. But yeah, how are they able to build these chillers on the electrical side to combat Vertiv? I'm not too sure. I'm not a patent law. I have no clue.
It could be a patent thing. Interesting.
I think, yeah, I know. They definitely have legit patents. It's legit technology. There's a legit scientist behind all of it. This isn't a company that just sprouted out of thin air last year. They've been around for a long time. It's just now that they're really expanding into this data center opportunity. So I know a few people who've actually flown out to their facilities, touched the products, and met with management team. They chat with management all the time. And it's funny, the CEO is a down-to-earth guy. I was listening to their earnings call, and he was like, yeah, I just cold emailed one of the heads execs at Vertiv, and we just chatted. And then after our chat, they're like, yeah, this is a really interesting opportunity. We'd like to partner up on this, basically. So look, it's an interesting spot. And they have a much higher inherent gross margin, which makes me think that this is actually a viable business long term. And they have something that stands out. It's not just kind of commoditized software or commoditized hardware. It's a real product. So yeah, that's kind of where I see it. That's all I basically have to say. We still need to see the revenue.
Does Vertiv or TGEN have any business in China? And I'm not asking because I'm that I think China's going to beat American AI, which they just definitely won't. But, we already know that there's going to be a massive data center run up, probably around the entire world, not just the US. But the fact that China is able to buy the NVIDIA H20 as well as the MI308 from AMD, I would imagine there's going to be somewhat of a ramp up in terms of data centers out there. So is that like some business they can get part of?
Yeah, I'm not sure, but I can't speak for Vertiv, but I'd imagine that that's not even on like the horizon for a small player like TechGen. I mean, if you just get a couple of projects here, and I've seen that there's like this there was a guy who was like, I should get the name of these companies better, but basically they run a bunch of data center projects, and they've been basically talking about working with TGEN products onto like different data center projects that they have in their portfolio. And they're just like, it's funny, like I have a bunch of people who do like, they stock LinkedIn comments and whatnot, and like the head of that thing is like commenting on TechGen stuff, saying this is a great product, blah blah blah.
Oh,
and
small cap investors are serious.
Insane. Yeah, they're nuts. So I mean, look, again, I just wanted to talk about this one today because it has run up a lot, and I'm not saying that, hey, this is a buy here. I mean, I did add actually today as it faded the entire earnings move. I didn't think it made sense. The earnings, it was up 30% until people probably realized, hey, like this is still a pilot project. Like the revenues aren't here today. They still need to prove that out. And it faded that entire move. I looked at that as an opportunity because you know what? They're a lot further than they were 2 months ago. So I increased my position as we faded, and you know I will be happy to continue to accumulate at these levels. So yeah, I mean, you know, I also found the stock at $2.70. It's sitting at $8.80 now, and it touched like almost $12 this morning. So it's obviously been a crazy one, but it's mostly because it's a small market cap. It has a real opportunity, and you know the revenues haven't really rolled in quite yet. So that's why it's an interesting one for sure.
So what's a price target?
If they land one notable significant data center deal, I think it's probably a $30 stock overnight.
So TGEN by 5,000 shares.
$4. If they don't land it in like the next 6 to 12 months, I wouldn't be surprised it's $4 stock. But it's something I'm comfortable with putting 4 or 5% of my portfolio and not caring, because it does seem like a legit management team. Yeah, it's a good one. It's legit. But again, I've also traded around it a lot, where like I was in at 270, sold it at $8, went to 10, came back down to 5, 6, bought it back. Now it's at 9. I've done a lot of that. So I've already booked some profits on this thing, and I trade around the core position. So, you know, it is what it is. I won't cry over spilt milk if things go bad, but I like the odds here, and it does seem like a legit business. So,
wow.
So guys, our next topic,
Mm-hmm.
I think we have bios, but I think that there might be a more pressing topic. Should we talk consumer? Should we talk CAVA? What's happening with CAVA and that whole space?
Oh man,
oh geez,
that
man.
Sweet Green, man. Ugh,
Sweet Green, CAVA, Chipotle,
man.
I'm so lucky. I tried to call a bottom on Sweet Green. Thank God I exited that position. I would have been torched, man.
What's happening? It's crazy. Like I went to a CAVA in Century City this just past weekend. It was 30 minutes. I had to wait in line to go eat there.
Right? All that matters for these things is not about expansion, number of stores. That stuff doesn't matter.
Same sales stores.
Yeah,
right.
Yep, that's all that matters. And if you start ticking down, I just looked at a table that was like showing the last few quarters of same store sales, and it was just like, oh yeah, like 10%, 8%, 5%. A lot of these just went negative, you know. And now I think Sweet Green put up 2 negative same store sales comps back to back. I mean, I talked about Gen Korean barbecue. That thing's been absolutely toast, and that's because a lot of those same store sales are negative. I mean, I think it's not a.
It's season one, man. Different time, different place.
So what does that tell you about the consumers? Like, nothing at all? You don't think so?
I don't think so, man. I wouldn't read into this stuff.
These places like CAVA and Sweet Greens, maybe a little bit of Chipotle, but that's like middle class type of place. I'm not saying that people who are not middle class can't go there, but they generally, when you walk in a store like that, they're generally placed in not necessarily affluent areas, but in areas where the income tends to be a little bit higher. And then just look at the way the economy is in terms of consumer sentiment. Yeah, GDP is strong, but a lot of the spending is really with like upper middle class. And okay, CAVA was a fad, in my opinion. It was all a fad. It was a big thing that everyone wanted to go to. Okay, the food's great and everything, but I remember walking into the line in CAVA a year ago. The line was out the door. I walked into one 2 weeks ago to get some water. There was no line in there. The place just opened up a year ago. So it already tells you a lot what's happening. And that's the reason why they're slowing down their same stores, or that's the reason why they're slowing down the amount of stores they're building and managing, because they're not seeing that demand.
Can I just pose a different perspective here, guys? These these companies were doing so great for the last 3 to 5 years. Everyone's already there. Shai, you just told me you waited 30 minutes in line. I bet you last year you were also waiting 30 minutes in line if you went there. So how many more, like what, did it go to 40 minutes in the line? Like, how do they grow same store sales? It's either got to be from volume or price. And I think that these companies have already taken as much price as they possibly can. What are we going to do? Pay $22 for a burrito? I mean, at some point you're going to lose customers. So if the price, you can't price out your customers, you can't, more people aren't going to show up. It's just a doomed business model to begin with. I don't know. That's just my thought.
Well, I think it's also it was a very expensive stock. I think we were pretty vocal in season 1. I was like, how's CAVA catching a bid above $100 when it's a consumer product? That's we all lived through Celsius, for example. A lot of investors were a Celsius investor. You saw how fickle, how quickly things can turn. All of a sudden, a year later, they weren't a grower. They had to acquire their way to growth all of a sudden. And now they turn to the Monster and Coca-Cola business model, where just 2 years ago, they were supposed to be the disruptors growing at crazy rates. I think that consumers change their decisions very quickly, a lot more quickly than the previous generations. I think that people are wanting new things, constantly changing, getting better. And if you're a high multiple in a space, like the pressure is insane, like any slip up. And I do think this is consumer related, though. I really do believe the high interest rate environment, what we're in year 3 of this, I think it's starting to squeeze a bit, where the interest expense of like the $500 a month interest expense alone is starting to add on. The jobs are not there. Spoiler, we're in the first wave of AI is disrupting the jobs. Eventually, there's going to be a ton of new jobs offered once we figure out how to use AI in society. But right now, it's a job displacement. And I think that combination is a little dangerous, where people aren't making more money and they are just spending, like their expenses are going higher and higher. And I think this is somewhat a component of the consumer wallet being stretched. I don't know. Maybe it's because it just makes too much sense for me. I'm not seeing any evidence. I have no data backing it up. I just view it as like all of them at the same time. That's crazy to me. Like, well, all of them.
You do have data backing it up, because every single month we get release in data for consumer sentiment, right? And even though it's based on a survey,
well, that's political though. That's the issue.
But it's trending down. It's been okay. I'm sorry, we got a new BLS commissioner, so maybe those numbers can be fixed a little bit. That might be the last time we get that report. But it's been trending down for years. So that kind of tells us something. But also, this is data in itself. What is it, like 70% plus of the amount of spending that happens in the economy is either from enterprise, or specifically with consumers, so not enterprise, is mostly from upper middle class or higher. And they are unimpacted by all of this because they own all the assets. If you have not owned any type of assets in the last 5 years, you have missed out in every single run up that you've seen in society. But on top of that, your dollars have become a lot weaker. Over time, that's just generally what's going to happen. So people who own stocks, they got rich. People who own property, they got rich. Just some sort of asset. Yeah, you don't have to be like buy and holding it, but at least have some sort of participation. And those are the people who are impacted by. You're in CAVA. You're eating at CAVA. You own assets. You're up 267% in the last 3 years.
I'm also Middle Eastern though. I love Mediterranean food,
there you go.
Especially fast dining. But I will say though, I also do believe that the GDP growth we're seeing right now is all due to AI. It's not really due to society 100%. Or consumers or stuff like that. So it's a little inflated, but also it's not, because we're about to enter a productivity boom. And I think that it's going to be prolonged, this GDP growth. But if the best hedge against AI disrupting your life is actually owning assets, like what Sam's saying, owning stocks, owning real estates, that is the best way to get ahead of that AI tsunami. That is somewhat of a life jacket. Now, maybe not a lifeboat for the AI tsunami, but life jackets. And I think that's a lot of people. We're still so early. Like, I know a lot of boomers out there who have never used an AI tool like ChatGPT. They have actually never logged on before, or Gemini, or grok. Like, it's crazy to me. I think we're in such a bubble where it feels kind of crazy that people have never used an AI tool, but we're still so much earlier in society for that. But yeah, I mean, it's tough if you were bullish on street greens and CAVA. I know there's some people that we know that was super bullish on CAVA, and it was defying expectations for quite a while, but it's not a Palantir, guys. Like, you have to know the difference between consumers and enterprise, that space for investing. It's a drastic different lens.
I know one thing we got to jump into bio because I really want to hear about SRPT. I know Logical has a lot to talk about that one, but we've been basically seeing healthcare in terms of legacy healthcare just getting obliterated. Also, we're seeing big conglomerates like Eli Lilly and Novo Nordisk trading at crazy valuations now, especially Novo Nordisk. A lot of that, of course, is legality with a lot of the pharma that's out there, but we even got news today that has to do with pharma as well. But, jumping into SRPT, to be honest, I don't even know. I don't want to butcher the company name, but I know this is beginning like a lot of eyes on Wall Street. So I'm wondering, like, what are your thoughts about that, Logical?
Yeah, I'll jump into that for a second. But real quick, did you say Novo Nordisk is expensive multiple? Because right now it's trading at like,
it's trading at a really cheap. Oh, I think I said its multiple is egregious.
I think because Eli Lilly is still pretty expensive. It's like 50 times earnings or something, even though they're the king. But then Novo Nordisk is trading at like 12 times or something like that. So it's Novo Nordisk very cheap. I actually went long that stock, as well as United Health, because I think those two make sense for a re-rate. But let's just jump into Sarepta. This one has had a long battle. I mean, this battle has been going on for years. So it's one of the first approved gene therapies on the market for DMD. I can't even pronounce what. Let me read the actual disease before I butcher the name. It is, sorry, my thing's in the way. Duchenne muscular dystrophy. Okay, I just didn't want to mispronounce that because, yeah. So it's a pretty serious rare disease. You basically lose motor function, and there's really not much you could do. The median life expectancy is 22 years. These patients don't have a lot of like really options of treating this. And so when Sarepta was approved, it was under the old FDA commissioner, Peter Marks, who has been ousted since the RFK took over the health services department. This was like his one very controversial approval that he did because Sarepta never met their primary endpoint. They actually failed their phase 3, but it was approved anyway, and it was given full approval. That's a very important language in the bios. There's accelerated approval and full approval. Think of accelerated as kind of like a half approval, and then like, let's monitor it after the fact and kind of see what's going on. And if it continues to show efficacy, then, because right now there's patients who need this treatment. Let's get it out there and let's keep monitoring it. But this thing got full approval. I did a ton of research over the weekend, and basically there's a lot of precedents of, I wouldn't say a lot, but there's quite a few precedents of accelerated approval drugs getting taken off of the market, but fully approved drugs, traditional approvals, don't typically get pulled off. So this company, SRPT, the reason why it's been in a lot of the news is because, again, there was a controversial approval, but in the last few months, we've learned of 3 different deaths in their patient population, and it's due to liver toxicity levels. But here's something that you need to understand is that there are 2 patient populations. One of them is ambulatory and the other one is non-ambulatory. The ambulatory population are patients that have a little bit more motor function, can walk on their own. Non-ambulatory means that they've already lost a lot of their motor functions, typically in wheelchairs, so they're unhealthier physically. And so they have full approval in the ambulatory with kids with motor function, and in the non-ambulatory, they have accelerated approval. So recently, the deaths have been in elevated toxic levels in the liver for the non-ambulatory. So the FDA basically removed all of Elevidys from the market, but they quickly reinstated it, but they only reinstated the ambulatory, which is the full approval. They still have the non-ambulatory taken off of the market. So that greatly reduces the total addressable market of patients for Sarepta. And it's a pretty complicated situation here because there's another wrench that's been thrown in, which is Vinay Prasad, who came to the FDA. And Vinay has been a very vocal critic on his podcast, etc., on social media of the FDA and the things that they approve. He's been notably like very vocal against like the COVID vaccines, and he's been put at the head of the CBER in the FDA. So for me, I did a deep dive on this company thinking, okay, well, what happens? What are the scenarios? So it feels like because there's not a lot of precedence of Elevidys, on the ambulatory population, the full approval getting pulled, that might be okay and stay on. That seems pretty likely. But the non-ambulatory, they're working on a label to talk about the risks. That can be put back onto the market, but that's a real big if because it's caused already a lot of deaths. It's possible to find ways with data to make sure that those safety events don't happen again. But again, without full approval, you're kind of at risk. Now, Sarepta has 3 other drugs that also treat, or 3 other treatments that are for DMD. They're called the PMOs. Look, I'm not like a super bioscientist, so I don't understand a lot of the exact situations. I think they just like target different things, but and so they work for different patients. But that makes up about half of their revenues. And the thing is that I didn't appreciate this risk. Those 3 other treatments are also accelerated approvals, and they have clinical data for efficacy due in April 2026 or by April 2026, which means that if they aren't able to show efficacy, then those 3 drugs are subject to be also pulled since they are only under accelerated approval. So all of a sudden, you have the non-ambulatory Elevidys pulled from the market, and you still have 3 of those other treatments, which make up half of their current revenues. Potentially, the FDA can pull them if they don't show efficacy. When I look through some of the data, again, just like Elevidys, those 3 other treatments were able to show statistical significance for the secondary endpoint, but not, I mean, at this point, those levels on the secondary endpoint are probably not going to translate to a statistically significant efficacy on the primary endpoint. So then you got to, now you don't have Peter Marks at the FDA anymore, right? Yes, this treatment's been going out. Yes, it does help patients. Yes, there is motor function, but there's still kind of like this risk of, what happens if it doesn't show efficacy? You don't have a champion for rare disease treatments like you did with Peter Marks back in the day, who approved Elevidys even when the primary endpoint failed. So it's kind of up in the air. Like, do half of their revenues disappear in the next couple of years on that side of the business? I think some would argue, hey, look, like these don't actually have any safety events like we did with Elevidys in the non-ambulatory patients. So maybe this should just stay on the market. I mean, there's still some clinical benefit here. So there's a decent chance that those also stay on the market. Their revenue stability is there. For the time being, I just said, man, this thing is giving me such a headache. I don't have the stock anymore. I'm regretting it every day because the stock's up like 15% since I said I paper handed it. And I feel like, my expected value on this stock was probably $38. We're going to come back to this episode and say it went to there and probably beyond. But it almost feels like a situation like where I held TMDX back when it was like had so much FUD around the lows. And the headache and the mental capital it took to hold that stock was so difficult. I have 20 positions. Meanwhile, one position is taking up 90% of my mental capacity. And yes, TMDX went on to double, but man, the amount of mental capital I was using every single day to hold that stock, it was just draining me. And so I moved on from that stock, and guess what? I'm still up 95% year to date. And, obviously I hope the best for these patients under Sarepta and all other gene therapy treatments and all that. But from holding it as a stock from an investor standpoint, you could argue, again, conservative expected value is probably like $38-40. So it could easily double. There's a gap fill right there. It makes sense. But do you want to like deal with the headaches of being so news driven? And again, that Vinay Prasad, who's been a real vocal critic of the FDA, he was ousted from the FDA. And then a week later, they brought him back. It is an absolute clown show at the FDA. But it's such a clown show at the FDA. You wonder, what about these clinical companies that have yet to come to market? Has it just become even more difficult to go from clinical to commercial stage and getting that FDA approval, given that the FDA has no clue what they're doing anymore? And that's what it looks like from anyone observing what's going on. So I wonder, is Sarepta now even a better long because their competitors are still in clinical stage and it's going to be even more difficult for them to get approval? I don't know. There's just so many question marks around this situation, and it gives me a headache. And so for the time being, I'm sitting on the sidelines, but that's basically the rundown. This is probably the most important name in XBI and the biotechs. And so just wanted to share that kind of all the research I did this weekend. I don't even know what to do, man. I'm like going to pass out from the amount of information and thought process that's been going on. But I know it's really top of mind for a lot of people and big point of contention from everyone. So wanted to share that.
Well, I could tell you what to do. Buy some DigitalOcean.
Yeah, that's probably way easier, man. Like, you don't need to there's so many things in this market where it's like, why am I trying so hard to get gains? Like, why do I want to do this? Anyways,
And then you look at your
That's-
portfolio performance of the year, and then you're happy.
yeah, it's like whatever. What am I doing, dude?
Well, no, look, honestly, the next episode we should, one episode in the coming month or so, we should do like a look back of what we regretted, what we should have done, what was so obvious. Like for me specifically, like the obvious themes, I should have kept in my themes: AI, space, quantum, electrification. We're in 4 super cycles right now. Super cycles don't happen every year; they happen every decade or so, if that. Even if we're lucky. So you find them category leaders, early disruptors in those sectors, you would have outperformed the market, who knows, probably like 5x, 6x the past couple of years, rather than trying to play cutes, trying to do all these little onesies like I'm sure all of us have been doing, where like, oh, valuation's too expensive, I'll just do a 5% position, etc. Just invest in the best in the themes that will high tide raises all boats. But any closing thoughts, Sam?
I mean, I agree. I'd say about 60% of my portfolio is concentrated in the leaders. Everything else is like smaller cap stuff that I got into that basically doubled to tripled since I got it, and now I'm in a much bigger position. Like, we didn't really talk about this. We should probably talk about it at some point, because we were talking about Datacenter earlier, is Nebius. I did bring this up in season 1, and that one has done pretty well. But a lot of that has to do with conviction, like just sticking through it when it has its drawdown, because there was like a good 3 months where like it just didn't do anything, and I just took that opportunity to keep adding to it, and I'm just gonna ride it out. Like, it's not really one of those things where I'm gonna kind of trade around it, because I'm certainly not good at that, and that's not really my forte. I'd rather just hold on to it because I allocated it in size and just letting it run, right? And could have said the same thing for CrowdStrike, probably when it was like $150 when it was trading at a much cheaper valuation. Today, obviously, it's much more than that. But at the same time, like, you had that scare with the outage that occurred a year ago. Like, it's been almost 13 months now, July 18, and that shook a lot of people out. A lot of people got out of it when that happened, and that created a lot of opportunity for people who didn't get in. And so did April. But like, outside of a huge macro event that happens like last April, these opportunities don't come often. And I think there's a handful of stocks that are in that opportunity phase right now where you could just get in, and it's like, it's a serious leader in its platform, but they're very small opportunity. I mean, if you're going for a trade, by all means, but like, if you want to like buy and hold something for a long period of time and continue with the story, a lot of the stuff is just gone. Like, a lot of the disruptors and leaders in their sectors, they already have priced in so much at this point that literally we have to wait for some sort of material pullback in order to get back in or get in some of these companies that we have our eye on. Go ahead.
So I think the most important thing for a lot of investors and listeners, if you miss down these winners, write down which names you want exposure in, because I can promise you, every year we have some wonky thing that pulls back the market. Every year we do. And yes, it might not go back to April lows, might not go back to August 2024 lows of the NK trade crisis, but if you use the anchored average VWAP from both of those lows and just track and just use that level on the names that you want exposure in, if those names will hit those levels, I promise you guys it will. And when it does, participate. And usually those names, like Axon, for example, I have no idea why Axon's pulling back 20% in the past 2 weeks. I have zero idea. It was a dominant earnings. They gave it back, probably valuation, profit taking towards high beta names, whatever it might be. Anchored average VWAP from the tariff wars is at 715. It got to 740. I don't think it hit 715 level, but 715 level would be an interesting place where I would participate. Probably if I have $1,000, I would probably do 10% of that and just start tracking it. But at least you have some exposure in that winner. I'm going to be doing that for the Googles, that Robinhoods, Nebiuses, all AMDs, all these names that are becoming winners and winners I missed out on. That's how I get my entry ticket for those winners. So I think it's really important to kind of have that conviction list ready.
Yeah, for sure, man.
Any last just one last thought. This earnings season gave you a gift, an opportunity. And that is that we talked about a lot of names that had these insane reactions to the downside, and in a lot of cases, what we think are overreactions. Now, what I've been doing in my portfolio is shuffling like crazy. Yes, I got hit on a lot of my names that were down 20, 25%. It happened. So many names were down a lot this earnings cycle. It was brutal. Even the good names were faded their entire moves to the downside. Look, here's the thing. You have an opportunity right now to go look at your names that had crappy earnings and say, hey, is this a real problem with this business? Is this just going to tread water for a while? Take those losses, cut the position, move on. Not financial advice. But then look for the names that saw an overreaction to the downside, are trading at good valuations, are leaders. I improved the quality of my portfolio as a whole by kind of cutting my losers, looking for those overreactions to the downside, and then moving those funds over there. So I got to lock in my losses, take that loss against my realized cap gains. I got to improve the quality of my positions, increase the conviction I have in these holdings. Like, Shai and I talked about, on the sidebar, I don't think we mentioned on here, but like Procept Biorobotics is one that's just been getting killed. It's now like 50% from its highs, had a good report up, put up 48% revenue growth, 69% international expansion growth, trading at 6 times sales for a very high quality medical device company, disrupting the prostate treatment space. So there's a lot of these good things, and right now in this moment this opportunity exists. 2 weeks from now I can't say what's going to happen. A lot of these names could already be recovered. Look at Shift4, $16 million buy from the CEO, or I should say ex-CEO and chairman Jared Isaacman, and that already, the stock's already moving, right? So you got to seize these opportunities right now, because they're going to be gone. And so I've improved the quality of my portfolio. I think it's a good time for investors to take a quick look at what's just been pissing you off, and is it time to kind of move on from this trade, and what else is going on in the market, because you have an opportunity to switch things around right now. Anyways, that's all I want to say.
Yep. So there you have it, guys. That was episode 3. We're still 2 weeks away from the NVIDIA earnings. And I feel like it's just, Jensen Huang's like swinging that little string in front of our face. We didn't even get to touch on the fact that NVIDIA supposedly is delaying their Rubin release, but we're probably going to get some more light on that for our episode next week.
Fake news.
Fake news?
I think it's fake news.
It was like some weird, news outlet, but it was all over Twitter. So you never know. You never know. Yeah, I mean, you never know. AMD was up like 6%. So like, I feel like some people thought that was real. But anyways, gonna cut it short this time. It was a great chat, guys. Talk to you guys next week.